We would never have cash around just to have cash.
10 mistakes every investor makes. When it comes to investing, few names resonate as powerfully as Warren Buffett. His wisdom, often distilled into simple, digestible advice, has guided countless investors toward financial success. Yet, even with his straightforward principles, many investors still fall into common traps. Here are 10 mistakes every investor makes, as highlighted by Buffett's philosophy and direct insights. Number 1. Hoarding cash without purpose.
We would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X%.
Buffett believes holding cash without a reason is wasteful. Instead of keeping a fixed amount, he thinks money should be invested in profitable ventures. Cash should only accumulate when there are no good investments or when reinvesting sales. The goal is to have money working in good businesses, not sitting idle. Many investors wrongly hoard cash for safety. While some liquidity is necessary, too much means missed opportunities. Buffett teaches that cash should come from smart investing, not be the main strategy. Essentially, cash is a tool, not a goal. Number 2. Following market predictions.
You may have trouble believing this, but Charlie and I never have an opinion about the market.
Buffett and Charlie Munger avoid predicting the market and focus on individual businesses. Many investors let market forecasts guide them, leading to missed opportunities. If a business is fundamentally strong, it should be invested in regardless of market conditions. Market predictions are often wrong, but many investors rely on them. Buffett advises investing in businesses with strong fundamentals instead of trying to predict the market. Focusing on individual businesses rather than market trends leads to better, less speculative decisions. Number 3. Over-diversification.
We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing.
Buffett believes that owning too many stocks reduces the potential returns for investors who understand businesses well. Diversification is often a way to protect against lack of knowledge. Instead, investors should focus on a few well-understood and strong companies. Owning 30 or 40 stocks often means holding some mediocre ones, which is not effective. The usual advice to diversify widely can result in a diluted portfolio with average results. Buffett's strategy is to invest heavily in a few high-confidence businesses. This approach requires a deep understanding and confidence in these businesses, but can lead to higher returns. Number 4. Misunderstanding risk.
Volatility does not measure risk, and the problem is that the people who have written and taught about risk do not know how to measure risk.
Buffett argues that volatility isn't a true measure of risk. He explains that lower prices, like farmland dropping in a crisis, don't always mean higher risk. Real risk comes from not understanding the business or its economic environment. Knowing the business and its managers well reduces actual investment risk. Many investors think volatility equals risk, but Buffett disagrees. True investment risk is the chance of permanently losing money, not short-term price changes. By understanding a business's intrinsic value and fundamentals, investors can reduce real risk and avoid reacting to market volatility. Number 5. Underestimating the importance of temperament.
It's the temperamental quality, not an intellectual quality. You don't need tons of IQ in this business.
Investing success relies more on temperament than intellect. Buffett emphasizes having a steady personality unaffected by market trends or popular opinion. Investors should trust their own research and reasoning, not follow the crowd. Clear, independent thinking leads to the best decisions, not emotional reactions. Emotions can cloud judgment in investing. Fear and greed cause impulsive choices, leading to poor outcomes. Buffett advises maintaining emotional stability and independent thinking for sound decisions. This approach keeps investors focused on long-term goals, not short-term market changes. Number 6. Relying on fixed asset allocations.
We think the best way to minimize risk is to think. And the idea that you have, you say, I've got 60% in stocks and 40% in bonds.
Buffett criticizes rigid asset allocation models from Wall Street. He prefers a flexible approach, starting with short-term investments and moving into opportunities as they come up, rather than following a fixed ratio of stocks to bonds. Smart investing needs adaptability and a focus on value, not sticking to set allocation rules. Fixed asset allocation models can give a false sense of security and reduce flexibility. Buffett's strategy encourages investors to stay nimble and seize opportunities. This dynamic approach aligns better with market conditions and specific investment chances, rather than being restricted by preset allocations. Number 7. Treating investing like gambling.
Desire of people to gamble, and they gamble in stocks, incidentally, too.
Buffett distinguishes between investing and gambling. He sees day trading and speculation as gambling, relying on luck rather than skill. True investing involves analyzing businesses and committing long-term. Governments have made gambling easier for revenue, exploiting people's ignorance and causing poor financial outcomes. Speculative activities mix investing with gambling. Buffett's approach focuses on fundamental analysis and long-term value, avoiding the high risks of gambling. By focusing on a business's intrinsic value and thinking long-term, investors can avoid speculative trading pitfalls. Number 8. Separating growth and value investing.
I've really said that growth and value, they're indistinguishable. They're part of the same equation.
Buffett doesn't separate growth and value stocks. He sees growth as valuable only if it increases future cash flows. For instance, growth in airlines can be harmful, while growth in low-capital businesses like See's Candy can be very profitable. Investors should focus on cash returns from growth, not labels. Separating growth and value can lead to missed opportunities. Buffett's approach includes growth in the value equation, emphasizing its role in boosting future cash flows. This helps investors find businesses with true long-term value, regardless of traditional labels. Number 9. Ignoring long-term prospects.
And by definition, a great company is one that's going to remain great for 30 years.
Buffett advises against waiting for market panics to buy great companies. If a business is fundamentally strong and will likely stay that way for decades, it's better to hold it long-term. Trying to time the market is hard and often leads to missed opportunities. Investors should focus on finding and keeping excellent businesses. Owning great businesses long-term is key to Buffett's strategy. Holding fundamentally sound companies allows investors to benefit from compounded growth over time. This long-term view reduces the need for frequent trading and helps investors weather market ups and downs while still achieving significant returns. Number 10. Overvaluing cash holdings.
People said cash is king a year ago. I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time.
Buffett believes holding too much cash is unproductive. While it's important to have enough for emergencies, excess cash loses value due to inflation. The goal should be to invest money in profitable opportunities. Cash is like oxygen, essential, but not something to hoard. Holding too much cash can reduce wealth over time. Buffett stresses the importance of actively investing in productive assets. By putting money into businesses with strong growth and solid fundamentals, investors can achieve better returns and protect their capital from inflation. Warren Buffett's investment philosophy focuses on understanding businesses, thinking independently, and committing long-term. Avoiding common mistakes leads to smarter and more profitable choices. By sticking to business basics, staying calm, and keeping money invested, investors can succeed like Buffett. Buffett's advice offers valuable guidance for all investors. Following these principles helps navigate financial markets and achieve lasting success. Effective investing means making informed, independent decisions. For more insights, consider subscribing to our channel for regular updates.